All right, let's talk about Superior Plus Corp. Now, imagine this. You find a company with a really juicy dividend, and it provides a service that people absolutely cannot live without. Sounds like the perfect investment, doesn't it? But what if that same company was also, quietly drowning in debt? Well, that's the puzzle we're trying to solve today.
And look, this isn't just some abstract thought experiment. For an investor, getting this wrong could be the difference between a nice, steady stream of income and a pretty devastating loss. So, is that big fat yield a sign of a strong company? Or is it just bait, luring us into a trap? That's exactly what we're here to find out.
Okay, so here's our game plan. We're going to crack this case by going on a real deep dive. First, we'll get to know the business, inside and out. Then, we'll run the numbers to figure out what it's really worth. After that, we're going to dig through the financials, look for clues, weigh the pros and cons, and figure out the exact price we need to pay to make this whole thing worthwhile. So yeah, definitely stick around for the final verdict.
All right, first things first. Let's get to know the company in question, Superior Plus Corp. What is it that they actually do?
So just think about those super cold winter nights. Superior Plus, they're the ones keeping the heat on for millions of homes and businesses, mostly by delivering propane. It's a business that's incredibly stable, almost recession-proof. Because let's be real, when it's freezing outside, paying your heating bill is not optional. But, and this is a big but, here's the catch. It's a tough business with super thin profit margins. And its success is at the mercy of everything from the weather to, and this is the big one, the crushing weight of its own debt.
Okay, so we've established it's a stable, essential business. But what is it actually worth? I want you to forget the stock price for just a second. Let's figure out the company's intrinsic value, what it's worth based on the cold, hard cash it can generate over time.
And this is where the story starts to get really, really interesting. See, we ran two different valuation models, and honestly, they're telling us two completely different stories. On one hand, a more optimistic model, the discounted cash flow, which kind of looks at future potential, says the company is worth over $8 a share. But then, a more conservative model, one based on its current earnings power, puts the value way lower at just $5.20.
You can think of it like a detective who's weighing different pieces of evidence. Neither model tells the whole story on its own, right? So when we blend them together, taking into account both that future potential and the present reality, we get our best guess at the truth. And that comes out to an intrinsic value of $6.65 per share.
And this right here brings us to maybe the single most important concept for any value investor. See this? The intrinsic value is $6.65 and the market price is $6.70. That tiny little gap, that's our margin of safety. And right now it's basically non-existent. It's like buying a house. You wouldn't pay the exact asking price if you knew there might be some hidden problems, would you? Of course not. You'd want a discount to protect yourself. But in this case, that discount is basically zero. We're being asked to pay full price for a company that has some very, very visible cracks in its foundation.
So that valuation, it isn't exactly screaming buy me. So let's pick up our magnifying glass and go look for more clues in the company's financial statements. Because, let's be honest, this is where the real story is often hiding in plain sight.
All right, let's start with the good stuff. Superior Plus definitely has a lot going for it. I mean, the business is pretty simple to understand, demand for heating fuel isn't going anywhere, and crucially, it consistently generates positive free cash flow. Plus, its massive distribution network gives it a real, even if it's a modest, competitive advantage or a moat over the smaller guys.
But now, okay, this is where the alarm bells start ringing, and trust me, they are loud. First off, the company is saddled with a massive amount of debt. To pay for its acquisitions, it's also been printing new shares like crazy, which has diluted existing shareholders, people who already own the stock, by over 31% in just 5 years. Oh, and that positive free cash flow we just mentioned? Yeah, that's been trending down.
And if there's a smoking gun, it's this number right here, Return on Invested Capital, or ROIC. Just imagine you're a baker for a second. ROIC tells you how much profit you're making for every single dollar you invest in your flour, your ovens, and your shop. Well, Superior Plus is only making about 3 cents a profit for every dollar it has invested. That is a terrible recipe. It tells us pretty clearly that their big acquisition strategy, all that money they've spent buying other companies, it's been a failure. It's actually been destroying value instead of creating it.
Okay, so now it's time for the ultimate showdown. We're going to pit the strengths against the serious risks. We're putting everything we've learned so far into the ring for a weighted analysis to see what really comes out on top.
And really, this chart tells us pretty much everything we need to know in a single picture. Yeah, sure, that stable demand is a huge strength. That's the 20% slice. But just look at the biggest slice of the pie here.
the single most important factor, the one that really outweighs everything else, it's that weakness from its mountain of debt. That, right there, is the #1 risk, bar none.
So what does all this mean for you as a potential investor? Let's forget the current market price again for a minute and ask a totally different question. What price would you need to pay to have a good shot at making, let's say, a 9% annual return on your money?
Now, check this out, because it's pretty cool. The price you should be willing to pay depends entirely on your time horizon, how long you plan to hold it. If you're only in it for 5 years, you need to buy the stock around $5.20. But if you're a true long-term investor, say 10 or 16 years, you can actually pay even less today because you're giving your investment so much more time to grow and compound.
And for that really long-term view, there it is, $4.50. For the patient investor, that's kind of the magic number. It's the price that finally bakes in that crucial margin of safety we keep talking about. It gives you a buffer against all those risks and a real fighting chance to actually hit that 9% return target.
So what could the future hold? Well, we can look at a few scenarios. In a worst case or bear case scenario, that debt becomes a black hole and the stock's real value falls to around $4. On the flip side, in a bull case, management pulls off a miraculous turnaround, they pay down that debt, and the stock could be worth $10. But our most likely scenario, our base case, puts us right back where we started, around that $6.50 intrinsic value.
All right, the evidence is in. The arguments have all been made. After digging through all the financials and running all the numbers, it is time to deliver the final verdict on Superior Plus Corp.
And you know what? This quote from the source analysis really says it all. The market isn't stupid. It sees the exact same things we do. A stable business, yes, but one that's completely handcuffed by its debt and a history of poor capital management. And so it has priced the stock accordingly.
And that leads us to a pretty clear verdict. It's a hold. At its current price, the company is what you'd call fairly valued. But for us, fairly valued just isn't good enough. We're looking for a bargain. So what should you do? Honestly, for now, I'd probably stay on the sidelines. The risks just don't seem to justify the potential reward at this price. There are simply better opportunities out there with a lot less baggage.
So let's just boil it all down to the key takeaways. Number 1, it's a stable business, but it's built on a very shaky foundation. Number 2, the stock is fairly priced, but it is absolutely no bargain. Number 3, if you're interested, wait for a big sale. A price down near $4.50 would be way more attractive. And finally, number 4, keep your eyes glued to the 2 things that matter most here: debt reduction and free cash flow trends. So there you have it. That's the story of Superior Plus Corp. It's really a perfect cautionary tale for any investor who's tempted to chase a high yield without popping the hood to see what's really going on with the engine. Now, I want to hear from you. What company should we put under the microscope next? Drop your suggestions in the comments below, and let's keep digging for those deep value opportunities.